The interest rates are too high. Inventory's too low. The real estate market's just right. Yeah. It's the Bitter Realtor Podcast. We're talking about all things Los Angeles real estate. If it's got four walls and a roof, we're talking about it bitterly. Hey everybody, welcome back to the Bitter Realtor Podcast. I'm your host, Joey Rockenstein, and still sitting shotgun on this real estate voyage, Scott Goldman.
Hello, bitter people.
Today's topic, real estate through the decades, starting with 1980, and what better person to help us with this discussion, none other than Neil Adler. Neil, thanks for being on the show.
Thank you for having me. I've been doing this for 30 years. I can't believe it's been that long.
30 years full of wisdom. Scott, you don't even have 1 year full of wisdom.
No, I rarely have a week's full of wisdom, Joe.
And I'm less than that. So let's start out with where we are in the current market, because we just didn't start here. We just didn't start at 7% or so interest rates. We didn't start out with low inventory. Neil, we're going back to 1980, where interest rates were at least 18%. What do you recall was going on in the market during that time with inventory, housing prices, the economy?
Well, actually, that was before I got into business, but I remember that, the inflation was pretty high and interest rates were in double digits. But I started doing this in '94, just as the market was starting to recover.
All right. And what was it recovering from?
Well, back then, with the high interest rates and the inflation, so I think interest rates were starting to come back down in the mid 90s.
And around that time, they were about what, would you say?
If I recall, I think they were probably like in the 7s or 8s.
So it's very interesting because people are complaining about where the rates are right now. But if you go back a couple of decades, like they were almost exactly the same.
I mean, it's a hair
right?
hair under 20% is a pretty high interest rate.
So what are we complaining about?
Well, people seem to forget that a couple, 3 years ago when rates were in the 2s and 3s, that was abnormally low and the market went crazy. So when we're at 6.5%, 7%, it seems high. People get a little spoiled, but actually, historically, when you're talking about rates in the mid 6s, that's not a bad rate.
Right.
I would agree, and I think it's very interesting that back in the 80s, it was an 18.5% interest rate.
So my question about
who
that
could afford a home then?
Right. What was the median income at that time? Maybe $25,000 a year that you were making?
I mean, my stepdad was making a shit ton of dough and bought a house in Malibu, but bought it at a
it wasn't
very
a $20 million house.
No, it was. I mean, now it is. Maybe it was 700,000 back then.
That's a little bit of appreciation.
Yeah, a little.
So my question now is because a lot of, let's say, millennials or Generation Zs are complaining that we're saying that the interest rates aren't that bad, that they were way worse, like say in the 80s when it was 18%. So what is the conversation that we're having? Because in the 80s, if it was 18% and the housing prices were like $18,000 to buy a house, and the affordability was better at that time, where are we at now as far as like the affordability? Like, what's the problem?
I always say that since I've worked with many first-time home buyers, you want to buy or sell a house because you want to, not because you have to. And I always tell people, if you're paying rent, you're paying a mortgage.
Mm-hmm.
You're paying somebody else's mortgage.
Mm-hmm.
And one of the things that I did many years ago when I worked with many first-time home buyers, we didn't necessarily talk about the interest rate and we didn't talk about the purchase price. What I would focus on, what kind of payment are you comfortable making? Because the price of the home doesn't necessarily mean anything unless they know what the payment is. So if they're paying rent of X and they can afford that, then I say, okay, how much do you have available for a down payment? Not that, and we want to make sure the cash they have is they don't want to use it all up. Well, I've got X amount of dollars. Okay, and then how's your credit? Well, I think it's pretty good. So when because I advertised and got lots of first-time home buyers, and I would kind of interview them before we brought them in person, ask them a few questions, and we want to try to keep it just brief as possible where we don't overwhelm them. And then what I would do is I'd have a mortgage broker that I work with. We would bring them in and explain the process, and they understood, okay, this is how we do it. And I remember I put countless number of people in their first home, and you know, a lot of them, that was back in the late 90s. And
Amazing.
It just, instead of renting, now they've got equity.
But it's interesting you say something because the conversation was very similar. I was talking to my dad about this when he bought houses in the 80s, and he was saying that, you know, he had to put down 20%, and at that time that was like around $6,000 for the houses he was looking at.
Which felt like
a lot.
$1 million.
It's like I didn't have $6,000, so I mean, $6,000 now
It's nothing. Right.
Yeah, it's a pinch.
But the upside is that the mortgage business or the programs have been much more friendly for buyers. FHA, you can get in with 3.5% down, and you don't have to have perfect credit. They have first-time home buyer programs. They also have what's called a 2-1 buy down, where you would qualify at the start rate, but the first year is 2% below what that is. The second year goes to the 1% below, and then the third year it goes to what the
current. So it is an
Right, that's what's going
adjustable.
on.
Exactly.
Yeah.
Yeah.
But the thing is that they have to qualify at the full rate. So that this way that they know that the payment they're making, and by year 3 that they can qualify instead of putting them into a payment that they can't make. And hopefully by that time, by year 3, the rates will come down. You refinance. And I've had a lot of people buy with the higher rates, and then when the rates got down, they refinanced
Right.
and stayed in their home.
And that's kind of like the current state of where we're at right now. But I'm curious as to, like, when you started out in the 90s and started building your career, you know, the rates were maybe like around 7%. There wasn't talk about a buy down at that
Right,
time.
right.
So what were you seeing as far as like inventory at that time versus how many buyers were out looking for houses?
And let's say we get in, you know, make an offer for 5% down at full price, and then they would counter. Well, they wanted to raise the price to cover the closing costs. So let's say
Hold on. So your buyer was making an offer at the ask,
right.
and then the seller was countering at a higher number?
Well, we would ask for a 3% credit for closing cost.
Okay.
So what they would do was that they would counter at, let's say, for example, 200,000, and we asked for 3% closing cost credit.
About $6,000.
Right. So they would come in, and the $6,000 basically would be net to the seller. And even though you don't finance closing costs over the cost of the loan, you're raising the price of the house by $6,000. But over a 30-year mortgage, you divide $6,000 by 360 payments. What's that? Maybe $50, $60.
But isn't that financing?
Well,
credit?
technically, you don't finance closing costs, and what you're doing is you're financing the closing costs in the price of the house.
Correct.
So you come in at, let's say, at $200,000 back then. You ask for a 3% credit. The seller wanted $6,000 net more, or to cover that, so they would bump the price up to make it, instead of $200,000, $206,000. They would get the $6,000 back. The buyer would get the $6,000 credit for the closing costs.
Correct.
And in essence, technically, you're not financing, but for all intents and purposes, the cost of the property went up $6,000. So you're covering the $6,000 in the increased price.
Which I don't think you can do anymore.
Well,
I think
you
the
know,
lenders would have a real hissy fit over something
That's
like
what the topic
Well,
that I've asked
well,
them if you could do that.
well-
And they were saying that no, you can't
Well,
finance
Yeah.
like commissions and or
Right.
credits.
Well, in essence, what you're doing is you're when you submit the offer, or I submit the offer for the buyer, we come in at X amount of price, and we ask for a credit for recurring and non-recurring closing costs. So the whole, and it's not an issue. The critical point is communication. You must communicate. So before I submit the offer, I will call the listing agent. Hey, my buyer's so-and-so. They've been pre-approved by such and such lender. This is what we're going to do. And then when I submit the offer, with the proof of funds, a pre-approval letter, and I also talk to the lender and have the lender reach out to the listing agent, so that, okay, we're all on the same page. And I would say that 9 times out of 10, when we make an offer, they counter back and it's done. So going back 4, 5, 6, 7 times, it just wears people down. So, and I've been trained in mediation, dispute resolution, and negotiation. And I would say, if you don't ask, you don't get. But when you're a buyer, and I say, when you're a buyer, you got to think like a seller. When you're a seller, you got to think like a buyer.
We talked about that last week.
Absolutely.
Yeah.
Yeah.
You always have to put yourself in the other side's
Right,
shoe.
right.
Yeah.
So you get in through the 90s and you're building your career successfully.
Right.
And we get through a couple of presidents at that time. We get through Bush and Clinton,
Right.
and we get it to another Bush. And so we're roughly in the 2000s now. Where would you say the market started going? Was it kind of going in a downward slope, or were you starting to pick things up a little bit? Because, you know, we're looking at rates slightly maybe increasing a little bit at that time too.
Well, if I recall, back around 2006, 2007, they were making loans to just about anybody.
Oh God, they were loaning
Yeah.
people money that wouldn't
Right.
loan themselves
Right.
money.
Right.
And then-
The
and
criteria seems to be like,
Yeah.
Right.
Did you
right.
make
If-
$10
right.
yesterday?
If you could breathe, if you could
do you
breathe.
have
If you
any
could
money-
breathe.
Do you have any money in your wallet right now?
So
Approved.
then 2008, that's when things turned sour. And I actually, back in 2008, 9, 10, and I was doing foreclosures, or they call them REOs, real estate owned.
Yeah.
After things took a
Right,
dive.
right.
Yeah.
So, and I also, many lending institutions had me do what's called a broker price opinion, BPOs, which is very similar to an appraisal.
Yep.
And what I would do is they would go to the property, and 90% of them were just drive-bys. I take the picture, and
They want a picture of the mailbox. They want a
Right.
picture of the
Well,
curb and
right,
the
right,
and,
right.
and the number, and they want this, and then they give you $50.
well, but I've done probably 4,000 to 5,000 BPOs.
Oh, good.
Let's talk about
Okay.
why that happened though, because before that the recession hit, like things kind of sort of were going crazy, and then the bubble burst, so to speak.
Well, the
They-
bank-owned
Well,
properties.
Lehman Brothers
you
was
know.
like, I'm out of here.
Yeah.
So
Well,
they-
the problem was that they gave just about anybody a loan who, and
That's right.
and then in 2008 and 9, then they started tightening things up, and so-
also
Well,
all
there
the
was
people kept-
Dodd-Frank.
And they kept refinancing, so
Yeah.
they pulled all the equity
Right.
out of their house, and so they were left standing on their head basically.
I think the line was that Wall Street got drunk. Got
Drunker.
drunk. I mean, people were getting loaned money, like I said. People who wouldn't loan money themselves were getting loaned money to go buy a home. And
You're a hot dog vendor? Here you go.
yeah, how many hot dogs did you sell? 3. Here's your $1 million.
Excellent work today.
Yeah, nice
well,
one.
yeah. Well, what they did was they really tightened up the restrictions too much. Now they're loosening them. Now I've never done loans, but I do know a lot about lending requirements. And typically, when I'm working with a buyer, I have lenders that I refer them to, but I kind of pre-qualify.
Of
How's
course.
your credit? What
Sure.
kind of payment can you make? How much cash do you have available? And in this way, that what I'll do is when I turn them over to a lender, I have a conference call and explain, okay, they can do this, this, and this, and then the lender talks to the buyer, and that's what we do. But again, communication is critical, and I have the buyers, I communicate with the buyer's lender and says, look, because there are restrictions that you can't unduly influence, but you can provide comps, what we comparables. And I've had more than one time where I met the appraiser at the property. Sometimes the listing agent never showed up as when I'm representing the buyer.
Shocker.
The buyer, and more than once, the appraiser has used my comps or comparables. And again, you can't unduly influence, but I use the standard criteria that appraiser would use to provide comparables. And almost every time that, especially as a listing agent, the property came in at value.
They almost always do. My experience is that appraisers very rarely come under value.
I've not seen too many of them.
I think it was like, couldn't have been $1,500. And I looked at her and I went,
like nothing.
I'm like, what?
Yeah.
Well,
She says, I represent the bank. I'm like, yeah, okay, all right.
I get it.
well, I mean, there's certain criteria. If it comes in at a certain price, that they'll still sell at that particular price. But I remember a few years
I don't know
ago-
what the threshold is.
Yeah, a couple of doors down that sold for $10,000 more than what we were in escrow
believe
for.
it.
And it was a pure comp.
Yeah.
Right.
Yeah.
And then what, I don't know how, because it was FHA, because typically FHA appraisals stay with the property. But I talked to the lender. He got another appraiser. I met that appraiser, and I said, here's comps. He looked at them, and they said, okay, because after we're done, I can't talk to him anymore. And the property
Right.
came in at the purchase price.
So I would say it's interesting, like how there's a lot of similarities between the decades, what's going on in the market. Because I would say inventory started having an issue maybe in around 2010-ish, moving on there. I know the market picked up around 2012 because that's when my wife was able to sell her mom's house when she inherited her mom's house, and the agent even told us like this is the first sale that I've had in a long time where it's multiple offers. So, and that's 2012, so that's 4 years after basically the recession.
Do you think it was because the property was priced right, or just because it was a very sought after?
It was a very sought after
Subject.
area.
Okay.
So, and it was a developer that bought it.
Okay.
So, but there was, a couple of developers came to the table.
So it's like an all cash deal?
Yeah.
Be repaid.
Oh, Joey will tell you stories where people are asking for a couple $100,000. But that's a whole other
On
show.
both sides of the table.
Yeah.
But keeping what we're talking about as far as like the decades, I really want to get to the part where the prices continue to rise, affordability becomes an issue, and this is around like the late 2010s. And then we start getting to the point where the pandemic hits. And so we're at 2020-ish, and the market freaks out. What was your opinion about what was going on in the market at the time before the interest rates greatly took a dive?
Well, I quite frankly, my focus is on my clients. And, as far as what's the market, I tell them, the main thing is I focus in on the client.
Right, but did you see what was going on in the market at that time though? Because I knew like a lot of big hitters like Andrew Spitz was freaking out because all the listings that he had canceled at that time. And I remember that specifically in the office. He told me that.
Yeah, well, the properties that I had listed, they all sold in a pretty fair amount of time. So again, price is just about it. Is everything. So the last thing you want to do is price it too low or price it too high. So my sellers were fine.
Interesting. But then the rates come down to like 2.6, 2.5%.
And the market goes crazy.
It goes crazy. Would you say, in your opinion, Neil, that those low interest rates greatly contributed to our housing shortage now? Because sellers who were going to sell said, no, I'm not going to sell, I'm going to refinance.
Right. That's correct. And then people that put it on the market, because rates are so cheap, they get multiple offers, and they were jacking up the prices. They would get,
Absolutely.
50, 60, 100, $200,000.
Oh,
Well, that
over
brings me to
ask, yeah.
Another point I was going to make is that was aspirational pricing. Because essentially, like people were sending out postcards with a campaign to their farm saying, name your price. Meaning, you could basically sell your home for the price that you wanted, and people were getting it. People were getting the price.
Well, as
they
Neil
wanted
said,
for
they're
their home.
going 100, 200,000 over.
Right.
I was number 3rd offer on a deal, and some influencer came in.
Like us?
And sure, and offered 200 grand over the asking price, all cash.
Right away.
And I wanted to take that listing agent out and dump him in the wash. I was so upset. And I don't normally get upset. My buyer was really upset.
You? Yeah.
So a lot of money came into the market.
Yes. But I think right now the market, in my opinion and experience, is returning a little back to normal.
Normal
And
action.
Seems like it.
And I hear
I agree.
that the Fed may drop rates, so rates are maybe coming, even though it does not directly influence the Fed rate to the interest rates, it does to a certain extent. And if it makes it more affordable, but what we want is a balance where we don't want too many buyers or too many sellers. We want a balanced market where a buyer can get what they want at a reasonable price and the seller gets what they want.
You're speaking of Xanadu. I don't know about this Xanadu you speak of. This Olivia Newton-John, Gene Kelly world you're describing. I just don't understand it. And if you look, the chart here will show that the market just essentially, at least in our area, just keeps going like that.
Yeah.
I mean, so when somebody says, well, Scott, I'm gonna wait till prices come down a little bit. Okay, you're gonna be looking in Arlington, Texas.
We're still on the trajectory of
Yeah.
these appreciating 4 to 6%.
I mean, you can't
every year.
you can't miss it. It's
Right.
it's straight up. There's some dips. You've seen them.
Yes.
But
And I hear that all the time. I'm waiting for prices to go.
Ah.
And
What do
then
you say?
I tell them, I said, look, you can wait and wait and wait, but in the meantime, if you're renting, every month that you write that check, where's that going?
Yeah.
Paying somebody else's mortgage.
Exactly.
Your money's not appreciated.
Exactly.
Yeah.
And the upside is, okay, that if you get it now and rates drop, you can always refinance, but at least if anything, the benefit to owning a home is you get tax benefit.
benefits.
Sure.
Obviously, they have to check with the tax professional about the mortgage interest deduction and property taxes, and you're building equity.
Right.
And this is your home,
That's
as
right.
opposed to renting. You can't do what you want, but it's your home. You make it the way you want.
Exactly right. And I guess we're lucky. We've got the fine folks from Guaranteed Rate. We've got Julie and Bruce and Marcelo helping us out.
Yes.
I love having an in-house
Right.
mortgage group. I go like this because they're up on the screen.
Okay.
Yeah.
But it's interesting because when you're talking about the Fed and how it influences the rates, one of the criteria that they've been waiting for is for unemployment to go up. So let me get this straight. You want people to be out of work and not to have an income to bring rates down so they can't afford to buy a home anymore. Am I wrong on that? Right.
Did you?
above my pay grade.
And I didn't
That's
do.
why you're here.
I did Econ 101, and it was just supply and demand for an hour every day. So, I guess the numbers don't make a lot of sense.
Well, I think the good news is that rates have started to tick down
Yes.
over the past couple weeks, have they not? So
Gas prices are falling.
We are below 7, and we're also in a presidential election
We are.
year. So that tends to be the traditional trajectory of real estate, is that real estate maybe slows down a little bit, rates happen to come down a little bit, but then once the election is over, things kind of like the frenzy starts up again.
And I've noticed, to your point, that a lot of people are sort of moved to the sidelines during this period
Correct.
of uncertainty. Stock market's on fire.
I just want to thank you so much for
Okay,
coming on the
thank
show. It's been really great to get someone's point of view that has like a lot of experience that you do. So it really helps me out a lot, I know, in my business, and I'm sure Scott too. So thank you for being here.
Thanks, Neil. We really
Well, thank
appreciate
you.
it.
And I always say the dumb questions are the ones you don't answer.
There we go. And if you guys have any dumb questions, you can DM us on Instagram. You can find Joey Rockenstein or Scott Goldman there. Neil, do you have a social media account or anything like that you need to plug?
I'm on Facebook, and my wife she's the expert.
There you go.
In social media and media.
She's off camera right
She's
here.
our
so-
studio audience. So we
Yes.
thank
Yeah.
you for being here.
Thank
That's
you.
right.
I'll tell you what, Neil, we're going to put your contact information in the show notes below, along with
Okay.
mine and Scott's.
Okay.
Guys, you can find this podcast on wherever you stream your podcast: Spotify, Google, Instagram,
TikTok,
YouTube, Stitcher.
Stitcher,
It's wherever you stream your
Flubber?
podcast. Guys,
Dancer.
I'm Joey Rockenstein for Scott Goldman. This is the Bitter Realtor Podcast. Why am I bitter? Because I'm a realtor.
Thank you.
Thank you.